8 of the last 9 Fed tightening cycles, the S&P 500 went up, not down, during the tightening. Now, it didn't go up as much, at 10% per year. You go back to 1972 and you look at the last 9 tightening cycles, stocks were up on 8 of them. The place you want to avoid, obviously, or it was long-term bonds because they're sensitive to rates. And particularly now when interest rates are so darn low on bonds to begin with, the risk reward still isn't that compelling. But stocks, you've got earnings growth estimates, if anything, going up. And so this year's decline has been driven by the multiple going down greater than the fact earnings estimates actually have still been going up a bit. So I'm still betting on equities for the long run, but I'm also betting on the Fed may in fact get it just right. And that's what I think the bond curve is telling you is there's only so many tightenings the economy can tolerate.
Alan, what happens before the long run, though? What does that path look like with the U.S. equity market? And I ask because, we are only about 4.5% off of all-time highs right now, but it's been a rocky first quarter, and we saw quite the recovery in the last 2 weeks.
Yeah, I think what's going on right now is I think you're watching a market which is still trying to get its head around what the implications are of all these cross dynamics. But, recognize valuations have driven. So selected software stocks have fallen now to their average valuations over the last 5 years. So this whole argument that stocks are overvalued, I don't think they're overvalued anymore. And so, crisis begets opportunity. There are certainly selected stocks, and I'll pick on the growth stocks, in a market that is going to struggle with long-term secular growth. Buying companies that can persistently grow earnings regardless of the economic environment still won't be winners. And so when the market hands you that opportunity and drives valuations down, those are the names out of the rubble that you want to start picking at, along with the large big cap winners, which clearly have held up. So I think the short run is, you have a little bit more of stock selection, but I would tell you growth is likely to continue to outperform value in the long run. That's not going to change.
But because we've seen longer term yields also moving up, is there some expectation that that's some confidence maybe about growth, but also a danger that eventually it'll crimp growth and equity valuations, which is, I think, something similar to what our John Author's writing about this, what we saw back in 2007.
Well, first of all, John Author's a plug for him. He's a fabulous writer, so I welcome people to read his writings on Bloomberg.
Me too, yeah.
What we would argue is, obviously you want to look at selected names, but as a generalization, there are a lot of companies that have durability in their revenue streams and licensing models that people renew payments. And in fact, if you're in a modestly inflationary environment, fees can go up, just like rents can go up on real estate alongside rates going up. So if the drop in valuation was driven exclusively by rates and not by the business model itself, if the actual costs of the business haven't gone up materially or can be passed on fully to the customers, those businesses are going to flourish. It's the businesses that are over-leveraged and are very dependent on economic growth that will indeed struggle in that rising rate environment and will continue to struggle.
Alan, one thing I would say, you sound like you have a lot of conviction and confidence, and you've seen a lot of market cycles, but I feel like, man, no one would have set us up. This is not what we were expecting in December. And I feel like the carpet got pulled out from under us in a lot of ways, even though a lot of folks were saying, we're getting overvalued, but the war, the continued move in inflation, people rethinking global energy supplies. What is the big caveat to what you're saying? And only got about 20, 30 seconds here.
COVID created an additional $4 trillion of cash sitting on bank balance sheets. You throw Ukraine, high inflation, interest rates to the market, and all it can do is fall 10%, peak to valley. That's telling you there's a ton of money on the sidelines ready to support this market, along with a strong, dynamic U.S. economy that's growing. So don't sell the U.S. short. Stay long-term oriented. Stay on your goals, but don't neglect the fact there's a lot of capital just aiming to get into this market at any kind of dip.
It's still pretty sloshy out there when it comes to liquidity. All right, Alan, thank you so much. Alan Zafran, he is founding partner and co-CEO at IEQ Capital, joining us once again on the phone from Foster City, California. And as we speak, we are just hovering around our best levels of the session. We're up about 0.7% on the S&P 500. Dow just up a hair percentage-wise, up 0.2%. NASDAQ really, once again, the outperformer, tech really leading the way. Thank you, Twitter. Thank you, Elon Musk. It is up about 1.8%. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to that closing bell, and here to help take us beyond the bell. It's our global simulcast with Carol Massar and Tim Stenovic. We welcome in our audiences across Bloomberg Television, radio, and YouTube. Carol, an update here. Not a broad-based rally, but when you look at some of those big cap, those heavyweight names in the indexes, they're all doing their part today.
Yeah, especially on the tech side. We're definitely seeing technology provide a lot of momentum to the trade here. We were just talking with Alan Zaffron over at IEQ Capital, and he said even with concerns about a raising rate environment, and something you and all of us have talked about, that he says it takes about 24 to 30 months before equities peak. So he's saying there is still more room to run here, Tim.
Hey, we're going to be speaking with Kathy Wood of ARK in just a few minutes. So I got my eye on what ARK is doing today, higher by 4.3%. That's the ARK Innovation ETF. It's up more than 35% from the lows of March 14th. We should note, still down more than 50% from last February's highs, but it has been on a tear since that bottom in March.
It certainly has been. Does it own Twitter?
It well, it owns a lot of Tesla in that one, and she owns Twitter in some of her funds too.
Yeah.
Meanwhile, Jen Psaki at the statement, of course, at the press briefing, talking about Elon Musk having invested in Twitter, saying, "I expect we'll continue to use Twitter." So far, the administration not put off.
Never thought about that angle, right?
Yeah, exactly.
We take a look at where we're at least though in these markets in the here and now. And you guys, I think what continues to stand out to me is when we talk about big tech, sort of the yields a higher movement that we continue to get on days like today. We were mentioning earlier on TV, Romaine, we're still above that sort of key 240 level on both the 2s and the 10s.
All right, well, you're looking at the closing bells here in New York. Look at this. The Dow Jones Industrial Average is going to finish the day higher by roughly 110 points here, up about 0.3%. The S&P 500 up 0.8% here. But the differential right now that we're seeing between the NASDAQ Composite, the NASDAQ 100, and the rest of the market, one of the widest differentials that we've seen, at least to the upside, in quite some time. I'll try to look it up and get a more accurate date for you here, but you're up 1.9% on the NASDAQ Composite, about 271 points. The NASDAQ 100 up an even 2% here on the day. As for the Russell 2000, those small caps, some of those cyclical names, not a whole lot going on there. About 0.2% here on the day.
NASDAQ still down about 7%. The NASDAQ 100 down about 7% still year to date, despite that big bounce that we've seen. S&P 500, guys, almost as even split. 252 names, Taylor, showing some gains in today's session. 248 lower, 5 unchanged.
You know, Carol, it's interesting, at least on the sector level for our radio audiences, we do the sector winners and the sector losers. It is green on the winners and red on the losers. So in that sense, maybe it does feel a little bit more broad-based. But when we dive into the surface, it's interesting. Autos, we've been talking about Tesla. Of course, that's one of the big outperformers. And technology really has been in there as well, right? Media and entertainment, technology, some of these semiconductors, those are all up at least 2% or more. You come down to the bottom, and some of the losers, and many of these are those bond proxies. You are seeing yields rise a little bit on the long end. So you're getting some dividend financials and those utilities as well. Those are off about 0.5% to 1%, Carol.
All right, we do have a headline crossing the Bloomberg. Twitter gaining 27%, its biggest rally, right, since that 2013 trading debut. So let's just say it again. We've talked about it a lot here and about an hour ago about the outperformance that we saw in Twitter shares. We know the news. Elon Musk buying a passive 9.2% stake in the company. He's now the biggest shareholder in the company. So a big move there. I feel like all of my gainers are kind of connected because take a look at Tesla. We know that one's up about 5.6%. We got some news about having a record first quarter in terms of some of its order flow, record first quarter deliveries, I should say. So that gave it a big boost as well. And then Hertz Global kind of playing into this because we know Hertz is buying a bunch of Tesla cars as it expands its EV exposure. Well, they came out, Hertz saying it's going to look to buy Polestar vehicles, about 65,000 EVs over the next 5 years. So we saw Hertz really moving a lot higher, top in the S&P 500, up about 11% today, guys.
All right, you got the gainers, Carol. I got the decliners. Let's go to Starbucks. Howard Schultz is back, and he's suspending share buyback. Shares of Starbucks falling as a result, down 3.7% today. He said the cash could be better spent on employees and stores. Among the many challenges that Schultz faces as he returns again as interim CEO this time, tight labor market, soaring costs, and then unionization efforts across the United States at different stores. Digital World Acquisition Corporation. We've talked a lot about social media today. A lot of the stocks higher. DWAC, not one of those. Down about 10% today. Carol mentioned Twitter as a gainer. This is the blank check firm that's bringing former President Trump's media venture public. It fell after a Reuters report reported that 2 key executives have resigned, and then that news about Elon Musk investing in Twitter, certainly not helping either. And then Baxter International falling 4% today. The medical device maker falling after Goldman Sachs downgraded it to a sell from neutral.
Meanwhile, let's go for a macro picture for a moment. Global macro movers really paint the story that is, once again, about Russia-Ukraine. We're worried about perhaps further sanctions coming towards Russia. This on the back, of course, of what atrocities many feel have occurred near Kiev. And that, of course, has calling from the French president, from many European leaders, that further sanctions are indeed needed on Russia. Would that envelop the world of commodities? Would that mean that grains could be harder to get out of the Black Sea? That's certainly what's pushed some of the grain prices higher. Could that mean that oil could be a focus? Energy markets in particular, factoring that in. WTI crude up more than 4%. We're $103 a barrel. Brent crude up more than 3.3%. So once again, the nervousness being factored in the commodity space. And that feeds into the FX space as well. Aussie dollar catches a bid up 0.6%, a key commodity-related currency pair. The Canadian dollar, the loonie, up 0.3%. Interestingly, on the downside, of course, what is the economic impact of further sanctions on Russia? The euro off by 0.7%. So worries there as to the overall slowing growth in the EU. And I look at what is perhaps a bit of a bid for safety that happens on the day on the back of this. Gilts, I mean, currently the UK 30-year bond, we saw money move in, yields pushed down by some 6 basis points. Interesting, we had some comments from the Bank of England today talking about perhaps, in fact, inflation undershooting when then anticipated. But we really saw money move in across the board in European debt and indeed Japanese. Taylor.
And you saw a similar story, Caroline, at least when you think about yields going higher here in full faith and credit on the longer end of that curve. It's always good to keep in mind, though, how far we've come. You think about sort of these 3 basis point moves on the front end. You got a 4 basis point move down on, at least in yield, lower on the front end, but still really above some of these key levels. Carol, as you think about a 2-year and a 10-year holding right in there at about a 240, you're just a little bit inverted by about negative 2 basis points. I think what was interesting, we were speaking with Subhadra Rajappa earlier about sort of needing a deeper inversion, and then talking a lot about not only the magnitude, but the duration as well, as you really think about any signals that this market can give us about the economics.
Yeah, and listen, this is why the economic data points this week, guys, and let's just kind of broaden out here a little bit. We're also going to get those FOMC meeting minutes. And what's interesting is we'll hear a little bit about the debate, right, between the members, and maybe we'll get some more clues about what the Fed's thinking, what it's watching. I mean, we get a lot of clarity when we get the press conference, but maybe we'll get a little bit more and maybe get some ideas about maybe where yields go next.
I think so. And I mean, we talk about the last minutes that we got. That actually surprised. Normally they're pretty staid, but you did get a lot of insight out of that one. I guess the big question right now is the runoff of that balance sheet, how aggressive that could be, particularly coupled, of course, with some of those rate hikes. And of course, you talk about some of the other data that we get here, not only with those FOMC minutes here, but I think some of the inventory levels that we're going to get towards the end of the week could actually also provide a little bit of insight into maybe where we go next with regards to inflation.
Yeah, certainly. Inflation. I mean, guys, I was out on, you missed me on Friday, but I went out on Friday afternoon, and a local bowling alley runner, the guy who runs it, said his utility costs, there were signs everywhere saying utilities have got skyrocketed, therefore they are putting up their prices across the board. They've gone from $3,000 a month to $12,000. And that's just one small business owner in the state. But overall, we are seeing still inflation pressure, whether that factored into commodities today, for example.
Well, Caroline, I have a question. I mean, was the owner having to pass along those costs?
Yes.
To what extent? I mean, you saw menu prices move higher, you saw bowling move higher. I mean, that's the way it works.
Yeah, but it was also packed because people are still wanting to be able to spend in some way. But at what point does that end up driving away demand? At what point does that overall have an impact on the way people feel as well? And is the Federal Reserve responding to that? We just had the CFO, COO of Lloyd's of London, and he was saying, well, he doesn't think the 7.9% inflation number in the US can possibly be real. He thinks it's far too high. But from a day-to-day person, I feel that many feel that is the real number.
Well, and we should point out there are a lot of people who feel the exact opposite. They feel that that number might actually be understating some of the inflationary effects.
And I think it's interesting. We had this conversation with Gina Martin-Adams, I think last week, Caroline, when we missed you on Friday, and really talking about, at least from that consumer sentiment, you don't see them pull back yet, but you do get nervous if it starts to broaden out. So if you see inflation and you think prices are going to move higher tomorrow, so you buy today, if that starts to extend to a lot of different areas in the economy, that's when you start to get nervous. Now, she caveated that with, you haven't started to see that. You haven't seen people say, I'm going to buy a house today because tomorrow it's going to be more expensive. But those are sort of the signals that she's looking for when it comes to this broader consumer sentiment.
What did you shoot, Caroline, when you were out bowling?
I'm hopeless. I either get a strike or I get zero. There is nothing in between. So I'm like the least consistent person, and I end up like having a really rubbish
plot,
night.
right? The estimates of where rates go. It's kind of
Depends
like
on also what point in the evening.
Yes, very good point.
There's some
I can relate.
involved.
Yeah, no, I just get distracted by conversation. That's all.
All right, guys, we're going to run. That's going to do it for our cross-platform coverage on radio, TV, and YouTube. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
The one thing I would say is that there's a great story in the Bloomberg, and it's entitled "Americans Finally Free of Debt Fear the End of $38 billion, excuse me, no, $3 billion in relief." So this talks to $3 billion in relief. All of the stimulus programs that have been out there, the amount of money that has cleaned up household balance sheets. Brookings did some great research that's talking about what better shape households are compared to pre-pandemic levels. That's real. If that goes away, that's going to impact spending.
So to what extent can they absorb higher energy costs? That's the question that remains.
Or higher costs of anything, right?
It's like all related to energy, right?
Right. As long as you feel flush with cash and there's money in the bank, you might be more inclined to spend. But when that goes away, you're going to start making some real decisions.
Let's get to Washington, D.C. for a check of the latest world and national news. Standing by is Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden says it's time to consider a war crimes trial after the release of photos showing what Russian soldiers are believed to have left behind in Bucha, including bodies of civilians who appeared to have been executed with their hands behind their backs. The U.S., at the request of Ukraine, is supporting a multinational team of international prosecutors who will help collect and analyze evidence of the atrocities with a view toward pursuing accountability. State Department spokesman Ned Price.
There are American experts, in some cases they're prosecutors, and some cases they're interdisciplinary experts, who are in their personal capacity working with this team that the Ukrainian prosecutor general has put together.
Price says the world must continue to hold to account those who are responsible for these heinous acts. With 18-wheelers as his backdrop on the White House lawn, President Biden is taking steps to remedy the shortage of truck drivers that's contributing to the supply chain issues.
The president said the government is making it easier to get a commercial driver's license, to make apprenticeships available for driver training, and to recruit women and military veterans to get behind the wheel.
We're building a better economy around American manufacturing and American supply chains. We've got to keep it going. If you can handle a tank, if you can handle an armored personnel carrier, you sure in hell can handle one of these suckers.
The president said he himself got a commercial driver's license in order to work at his father's auto shop. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Carol Masser, Tim Stenovic here on Bloomberg Radio and Bloomberg Business Week. We just want to point out that just in a few minutes, we're going to catch up with Kathy Wood of ARK Investment. We're going to talk Tesla, Twitter, so much. So looking forward to that conversation. In the meantime, one story that definitely caught our attention has to do with a hacker who moved stolen crypto funds from Ronin Breach to Obfuscator. I feel like I'm always speaking a foreign language with this stuff.
You're not the only one, Carol. About $7 million of Ether sent to Tornado Cash. That's according to data. Muyao Shen, who covers the industry very closely here at Bloomberg News, writing this story. A hacker moving some of the roughly $600 million in cryptocurrency that was stolen from the Axie Infinity play-to-earn gaming platform to a service that helps users mask transactions. About 2,000 Ether tokens, valued at around $7 million, that were lifted from Axie Infinity's Ronin software bridge last month were moved on Monday to Tornado Cash. That's according to blockchain data. Tornado Cash founders did not respond Monday to a request for comment.
So it's interesting. So this is the technology breaking the link between the sender and receiver's addresses. So the significance of this is what?
Well, the hack had to do with a bridge.
Right.
And the bridge is the piece of technology that's used to transfer from one blockchain to another blockchain. And we had
So does this go to security issues, basically?
Absolutely, security issues, yeah. We had Olga Karif on Quick Take Stock last week, who's been covering the crypto industry for longer than most people have even heard about crypto.
Right.
And she told us that the problem with these bridges is that they have all this unaudited code and that people don't really know what sort of lies beneath that code. And it's really difficult to know if what you're using is secure or not.
Which is, the longer this goes on, right, in our understanding of crypto and blockchain and how it all connects to one another, we're realizing that the security of it isn't always secure, right? The transparency or the ability to kind of hide things also, or be discovered, that isn't necessarily true, right? We've talked about governments kind of figuring out things. So it's interesting that we just continue to learn a little bit more about kind of the truth of it.
I think the story continues, Carol.
I would say it does indeed.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It was an up day for the Dow, the S&P, and NASDAQ. S&P up 36, a gain of 0.8%. The Dow up 103, higher by 0.3%. NASDAQ up 271, higher by 1.9%. 10-year yield 2.41%. Spot gold up 0.3%, 19.31 the ounce. I'm Charlie Pellet. That is a Bloomberg Business Flash.
You're listening to Bloomberg Business Week on Bloomberg Radio. We welcome everyone who's watching on Bloomberg TV and really welcome Kathy Wood, who is back with us. She's the founder, CEO, and CIO of ARK Investment, and she joins us on Zoom from Florida. Kathy, so good to have you here with us. I feel like I have a million questions to talk to you. How are you?
I'm great. How are you doing, Carol? Delighted to be here, as always.
Well, it's great to have you here, trying to keep up with the news flow. And I got to say, I think a lot of us were a little surprised by Elon Musk and his investment in Twitter, that passive investment, 9.2%. You are a big investor in Tesla, have been for a long time. I think about 2.5% of your funds are in Twitter as well. Was this a smart move by Elon?
Well, I do think for the moment it's passive, but he's certainly making a statement, and it's a statement about censorship. He doesn't agree with censorship for as smooth functioning democracy as he has tweeted, I believe. And so I think he's sending a strong signal to the new CEO. And I also know there's some controversy about why Jack left, having to do with this new CEO. So a few messages there.
Have you talked to Elon at all about it?
No, I have not.
Okay. And would you be buying either more Tesla or Twitter on the news? And let's throw on Tesla also having this record first quarter. Is this a catalyst to buy more of these shares in your view?
On Tesla, we post our trades at the end of every day, so many will know that it is the largest position in our flagship portfolio and in most of the portfolios where we hold it. But we have been selling recently because of how well it has done relative to the rest of the stocks in our portfolio. So it has levitated relative. And so it's been a good source of cash. We've taken profits and redeployed them into other stocks that we thought were being unfairly penalized here. And I think one of the reasons for that is Tesla's in the indexes, the broad-based indices, and most of our other stocks are not. That's a big problem out there in terms of the way capital is being allocated these days in the public equity markets.
Kathy, how much would Tesla have to fall for you to start buying again?
Well, even now we're going to put out another model on GitHub I'm going to say within a week. Our last one is from about a year ago, and you'll see from that model that our price expectation at that time was $3,000. So there's still a lot of running room ahead for Tesla. But relative to the other names in our portfolio, even though that's a triple or nearly a triple, other names in our portfolio, we believe, will deliver much more than that over the next 5 years because they have been hit so hard. They're not in indexes. And so when there are risk-off periods, traditional investors really diversify and sell our stocks as they move closer to their benchmarks, the benchmarks against which they are measured. So it's a great buying opportunity for us. I will say I can't believe how long that buying opportunity lasted from February of a year ago to a few weeks ago. But we think the concentration of our portfolios towards our highest conviction names will pay off. As for Twitter, well, it's having a beautiful day today. And I think there are some investors relieved that someone is willing to speak up and say, hey, you're going to ruin this platform if you continue to censor it in somewhat random ways. So I think that's good. I will say this could be setting up for another leadership change at Twitter. You never know. And so that will bring with it perhaps some uncertainty and dislocation. So especially as it relates to advertisers. So we shall see.
So Kathy, uncertainty potentially at Twitter, a potential leadership change. Who are the names that you would like to see lead Twitter? Who could do a great job in your opinion?
Oh, I am not going to speculate on that. And to be honest, we haven't thought about it that carefully. There are names flying around, but I wouldn't want to throw out anything there unless we felt very strongly. So we will wait to see whose names are put forth. But whoever is put forth, and I'm not jumping to this conclusion automatically. I'm saying it's one of many possibilities. It'll either be Agarwal changing the policy of the company to, really open source the censorship or call people out on censorship, or it will be a management change. I don't know what's going to happen at all.
You use the platform a lot, Kathy. You own the platform. What are the specific changes that you would like to see, perhaps Elon Musk, if he would be vocal about it, push for at Twitter?
Well, I think he's already pushing for it. He's been pretty vocal, talking about censorship not being good for the platform, which is, really the world's platform, engagement platform. And yes, we do use it liberally. We have not been banished yet, but you never know. You never know.
Well, I'm curious too, in terms of Elon Musk, Kathy, looking at Twitter, making this investment, does it make you want to look at some of the other social opinion platforms that are out there and social media platforms, whether it's Meta, which has certainly been beaten up big time? Does it make you want to kind of look at them as for either further investments or initial investments?
Not really. I think what's happening, the ground is shifting underneath social media. I don't think anyone understood until Facebook reported or gave guidance for the first quarter how provocatively disruptive TikTok had become. I mean, I know I've seen my children and their generation spend a lot more time on TikTok and wondered, how would this impact Facebook? But I also know that there's a huge advertising shift from linear TV to social. So you had those two opposing forces. Well, it appears that TikTok is being much more disruptive than we thought. And not just Facebook, but Netflix has talked about it as well. This is competition for the consumer's time. And so I think, again, the ground is shifting. And if you think about it, a Facebook, when you think about Instagram and Facebook itself, it's all about me. It's, I am central. If you think about TikTok, it's about how can I entertain you? It's a completely different DNA. So I'm not so sure that Reels is going to make it the way that Stories did. Stories was about me. Facebook got that. TikTok is a completely different animal here.
Hey, Kathy, got to ask you about Chinese stocks. You and I have certainly had conversations, and you've made investments in, you've gotten out, and I just want to know where you are in Chinese stocks right now, because we've seen quite a bounce back in the last couple of days, still down a lot if I look at something like the NASDAQ Golden Dragon. Would you be committing new money? Do you have faith in Chinese authorities actually making Chinese companies much more transparent for U.S. investors, especially when it comes to financially sensitive information?
Well, I think that the government is showing that at the margin, it's going to make moves, but they're going to be marginal moves. In this case, I think there are 3 years to comply with our audit requirements. So they're talking they're talking, and so we'll see what happens. Common prosperity to us means that high profit margins are not a good thing. And so we have steered away from anything with a high profit margin. And we have focused on those companies, and we've in our flagship strategy, we're out completely. We've shifted towards something like C Limited in Singapore. But in more specialized strategies, we're looking for very low margin companies that are consistent with common prosperity, really distributing goods and services into lower tier cities, for example, or providing transportation. So Xpeng, NEO, we have bought their very low margin. It's all about next gen transportation in a world where, human-driven cars are still, relative to the eligible drivers, still very low percentage. So We're interested there. JD Logistics in the logistics area using drones, but lots of innovation. They're doing a lot, again, pushing into the lower tier cities. So we're a bit gun shy. We don't think that the Chinese government is thinking very much about treating capital well. But we know there are huge opportunities consistent with common prosperity. And so we will have an allocation, but until things change dramatically, meaning more of friendly to capital, we'll probably keep that exposure pretty low.
Hey, Kathy, one thing, I mean, you and your team are very good about research, right? And you open it up to the world and you want to have these conversations. I am curious, when we look at the world, specifically what's going on in Ukraine and Russia, China's relationship specifically with, it seems like, wanting to continue some kind of relationship with Russia. How is that problematic, do you think, for investors going forward and ultimately Chinese companies? And is there kind of a rethink on what our global markets ultimately will be like longer term? You are a longer term think individual.
Yes, yes. Well, one thing I do know about China is it's a survivor, and it really does want to be, it really wants to be in the lead in terms of innovation. So we, given our sole focus on disruptive innovation, are not going to dismiss China. But these geopolitical strains are not going to be good. Again, it's capital unfriendly. We do know that innovation solves problems. And starting with COVID, we had a lot of problems. Now with the the Russian invasion of Ukraine, we have a lot more problems. And so we think innovation generally is going to help solve those problems. And so we're happy that the market is now turning its sights back to innovation being a good thing and non-index stocks being an area of great opportunity.
All right, we are, of course, talking with Kathy Wood, the founder, chief investment officer, and CEO of ARK Invest. And for those of you watching on Bloomberg TV, Triple Take with our Bloomberg TV colleagues will begin right now. On radio, we're going to continue our conversation with Kathy Wood. So, Kathy, you know, one thing I want to get to, and this is something you guys have been writing about over at ARK, and that is passive versus active when it comes to indexing. There has been, as you know, so much money going into passive indexing and investments. Not a good thing, ultimately. Do you think investors in that world are going to ultimately be burned?
One of the reasons I founded ARK Invest is I believed that, taken to an extreme, which is where I think it is now, that index-based investing was going to lead to the most massive misallocation of capital in history. And I think that's happening. And you saw what happened to our pure play innovation-based strategy over the past year when fears about inflation and interest rates picked up. There was risk off. And this movement back to broad-based benchmarks and other benchmarks and away from our strategies. And so we saw a stock like Invitae go from $60 to $7 or $8 in the span of a year. This doesn't make any sense. We have in our portfolio, and we have used this risk-off period to concentrate towards our highest conviction names. We've gone in the flagship portfolio from 58 names, I believe, down to 35, which is essentially saying, okay, we're not so sure that these 22 or 23 stocks are going to be as a pure play of disruptive innovation as we are that these other 35 are. And of course, Tesla is the leader of the gang there. So yes, we've been surprised that the risk-off lasted that long, that the shift into passive and indexed lasted that long, but it set us up for some great opportunities here as we have so many problems to solve, and innovation is the right way to solve those problems.
Kathy, what would you say to somebody who's listening right now who says study after study that they read shows that on average, the active manager does not outperform the benchmarks, especially after fees year in and year out?
Yes, we certainly have. Our time horizon is a 5-year investment time horizon, and I would agree with you. I think the vast majority of active managers have underperformed. We have significantly outperformed over that 5-year period at a compound annual rate. And I think one of the reasons there is underperformance is this benchmark hugging behavior. So they are very close to their benchmarks. And then and that to me is as close to passive investing as you can get. And then they charge a fee for it. We are not in those indexed stocks. We are really focused on the future, not on the past. Indexes are where they are because of what has happened historically. And those at the highest end of the indexes, the largest positions, are there because of past performance. If we are right, we are facing the most disruptive innovation in the history of the world. 5 innovation platforms: genomic sequencing, adaptive robotics, energy storage, artificial intelligence, blockchain technology. They involve 14 technologies, and there are all kinds of convergences between and among them. So they're setting up for explosive growth opportunities, but they're not being well followed, well researched. That's one of the reasons we do publish our research. We want to educate investors, but not just investors. We want to educate parents and grandparents. Here's how the world is changing. Make sure to guide your children or your grandchildren toward the right side of change so they don't end up working for these companies who are going to be completely disrupted. So I think many people, a case in point, and I don't think Facebook is going to necessarily be a bad stock going forward, but the fact that a disruptor like Facebook could be disrupted so quickly is an important case in point.
Well, this is what I love, Kathy, and I think about the years we've been talking about, and you go back 7 years or so when you started, like your thoughts about disruption and innovation. How has it changed to kind of where we are today, especially as we're watching, what's going on in Russia and Ukraine, and I feel like the energy conversation has pivoted very quickly as well.
Yes, well, a couple of things are happening. Many people have focused on my very long-term oil price forecast.
$12, is it?
Yes, and I say that to make a point. We started on this journey, towards energy conservation and so forth after OPEC quadrupled oil prices in the early 70s to $12. That's why I use that as a marker. And so that was the beginning of the journey. Now we are moving into overdrive, given what's happened to energy prices on the one hand, but just as important, where we are in the migration to electric transportation. We have hit escape velocity. Last year, there were 4.8 million EVs sold. When I first spoke to you, Carol, it was either 2014 or 2015, I believe IHS was predicting that in the year 2022, that there would be 250,000 electric vehicles sold.
Big difference.
We sold 4.8 million, and we were much closer to the mark, Now we see 40 million in 5 years. That'll be almost a half of all autos sold. So I do believe it is possible that oil demand peaked in 2019. It is not back there yet. And I believe this price increase is destroying demand. You're seeing substitution. I see a lot more scooters and bikes around here, for example, or fewer trips. And you're also seeing a shift now, accelerated shift towards electric. And China is a huge part of this. Now, China may have coal as the biggest part of its electric generation, but it's not oil. Well, so I have a feeling we're going to be shocked at how much the demand for oil underperforms expectations.
What's the time frame on that, though? Like, you're right. You say that $12 to shock, but I mean, I do wonder you are longer term, but I mean, so when is it that we see oil come way down because of this shift, being much more aggressive?
Well, it's been very interesting. In 2008, the oil price peaked at, I think it was $147 per barrel. Well, given what's happened in Russia, Ukraine, I thought, okay, traders are just going back to that old high because, who knows where this is going now with this supply shock. And it didn't get there. It got to 130, and then it retested. It got to 114. Maybe if it doesn't go any higher than that, maybe again, the all-time peak was in 2009 at 147, and we are going down from here as Europe ends up in recession. We think it's probably there. China is slowing down dramatically, and the US is much slower than we think most people realize.
What about when it comes to energy generation in general, Kathy? Because you got to charge these electric vehicles some way, and we're seeing spikes in commodities, we're seeing spikes in energy across the board, and we're seeing the difficult way or impossible way that Europe is trying to wean itself off of Russian energy. So what replaces ultimately those fossil fuels?
Well, I think from a national security point of view right now, that our government, and I think we're seeing signs that it's starting to move in this direction, should encourage as much oil production as possible. I know ESG and other considerations are out there, but national security is paramount right now, and helping our allies is paramount. So that's the first thing. And that's the other thing that will get oil prices going down. Another energy source that we think is on the rise, and especially as we have Elon Musk and others starting to support it, is nuclear, new modular nuclear energy. And that is the cleanest. That's one of the cleanest energy sources out there. We know we've got hydro in the United States. I think that's about 20%. Nuclear is about 20%. Natural gas and then coal. So obviously natural gas is cleaner, much cleaner than coal. We're starting to wean ourselves more and more from that. So I think nuclear is going to make a renaissance in the next few years. We're seeing China rolling out nuclear. We're also seeing, I heard recently that Japan, even after the shock of Fukushima, when they decided to close all of their nuclear facilities down, I think they've started reopening some of them, probably in the safer areas of the country, safer meaning from earthquakes and such, because of what's going on in the energy sector now. So I think the big surprise is going to be nuclear.
Hey, Kathy, I got to ask you, and you've always been so good about, the highs and lows of this business. And, it's a lot easier when the returns are coming in and the money flows are coming in. And your fund has had a really significant, the ARC Innovation, if I think about it, has had a significant bounce back. But still, it's way down from its highs here. What's the difficulty for you and your team and your investors about this pullback? What's the trickier part in kind of being true to your long-term investment theories?
Well, I have to say that we are so grateful to our clients because the retention, the staying power has been phenomenal. Last year, for example, we net inflowed $17 billion. Now, the gross inflow last year was $21 billion. Most of that was at the beginning of the year, but we kept $17 billion of that. Mm-hmm. And I think what's happening is our investors are averaging down. This year, we have been net inflowing. And in fact, since, there were two very controversial moments on TV associated with ARC, we've inflowed more than $1 billion. So, and what's also very interesting is our inflows picked up, and it looks like our performance turned right around the time of the first Fed hike. We think that the Fed hikes are priced into the market. If you look at the 2-year Treasury yield, you'll see most of those are priced in. And very recently, the first Fed president that I heard equivocate at all was Kashkari from Minneapolis. And he said, maybe, the yield curve is not suggesting that this inflation that we're seeing now is going to be sustained. And that was a bit of a breakthrough, I think, for the market. Not many people noticed it because other Fed presidents and governors are saying, maybe we go up 50 basis points at the next one. Well, if we go up 58 basis points, then the inversion of the yield curve that we've seen recently is going to get worse.
Right.
And that typically is associated with either lower than expected growth or inflation in the following year.
Hey, Kathy, we don't have a ton of time with you, and I want to make sure that I'm understanding how you're thinking about the future for ARK Invest now. ARK has more than $20 billion in assets under management across just 9 ETFs. I'm wondering, when you think about thematic investing, thematic ETFs, where the next opportunity for ARK is. What's the next ETF?
Well, first, let me set this up. So we have, yes, 20 billion in the ETFs, about double that in total for the firm, a little more than double that. And what do we think is next? I think what many people find interesting is that we have so few ETFs and so much in AUM in ETFs. And the reason is these ETFs are going to scale with these enormous opportunities. What are we going to do in the future? Well, there are a few. We have a few ideas, but what we really expect is what we have out there right now is going to enjoy outsized growth. If our research is correct, and these 5 innovation platforms have hit escape velocity, we believe they have. So in terms of, what is we did file a registration for a crossover fund. That's a 40 Act fund, but it is not an ETF. So stay tuned. Stay tuned.
All right. Do you anticipate any kind of announcements anytime soon?
Well, we're waiting for the SEC to approve, and then we're going to be very excited to share some news about a new distribution platform and a new way of doing things, and including staying true to our brand: disruptive innovation, transparency, and democratizing the opportunities.
All right, we're going to leave it on that note. Kathy, so appreciate all this time and getting to talk about so many different things, as always. Kathy, thank you. Be well. Kathy Wood, of course, founder, CEO, and CIO of ARK Investment, joining us on the Zoom from Florida, but really covering so much ground of the stories and topics that are so relevant in today's market environment, Tim.
Yeah, especially her comments about Twitter and what potentially Elon Musk could do with Twitter. Realizing that we have to look to what Elon Musk has tweeted, even though he's a passive investor in Twitter, he's got a lot of thoughts on what the company needs to do.
Absolutely.
And it seems like Kathy agrees.
And both of them are very familiar with really the power of Twitter and use it really effectively. All right, let's get back to world and national news. For that, it's over to Nancy Lyons. She's in our DC newsroom. Hey, Nance.
Thanks, Carol. President Biden is calling for a war crimes investigation into Russia and President Vladimir Putin following evidence of what Ukraine is calling torture in the Kyiv suburb of Bucha. Among the alleged atrocities is shooting unarmed civilians with their hands tied behind their backs.
You may remember I got criticized for calling Putin a war criminal. Well, the truth of the matter is so it happened in Bucha. This warrants him. He is a war criminal.
President Biden stopped short of calling the deaths genocide, even though that is what Ukraine's President Zelensky calls it. Biden did say he wants the U.S. to add more sanctions against Russia. Germany says it's expelling 40 Russian diplomats in response to the killings in Bucha. Well, after a delay due to travel issues for one senator, the Senate Judiciary Committee has finally voted 11-11 on the Supreme Court nomination of Judge Ketanji Brown Jackson. A procedural vote is now expected by the full Senate later this evening. Earlier in the day, Democratic Senator Dick Durbin spoke of her qualifications.
She has impeccable qualifications. We don't agree on much in the Senate, but not one senator on this committee has questioned that she is well qualified.
Durbin says Judge Jackson is fair and independent, but Republicans on the committee say her views are too liberal. Inflation is hitting egg prices, but it's not due to the pandemic or the Russian invasion of Ukraine. Officials say it's because of the bird flu. The Agriculture Department says tens of millions of infected chickens and turkeys have been destroyed in an attempt to stop the spread. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now back to you, Carol and Tim.
Thank you so much for that update, Nancy Lyons. Let's also get an update on what's going on in the world of business news. Here with the latest is Charlie Pellet.
Thank you very much. It was an update on Wall Street with the Dow, the S&P, NASDAQ all advancing today. Investors were assessing the latest central bank commentary along with developments in Ukraine. S&P up 36, a gain of 0.8%. The Dow up 103, up 0.3. NASDAQ up 271, a gain today of 1.9%. 10-year yield 2.39%, 2-year yield 2.41%. Spot gold up 0.4%, 19.33 the ounce. West Texas Intermediate crude rallied 4.5%, 103.73 a barrel. Tesla CEO Elon Musk has taken a 9.2% stake in Twitter to become the platform's biggest shareholder, a week after hinting he might shake up the social media industry. Kathy Wood is founder of ARK Investments, which runs the ARK Innovation ETF. Tesla is its top holding. She talked about Musk's investment in Twitter moments ago right here on Bloomberg Radio.
I will say this could be setting up for another leadership change at Twitter. You never know. And so that will bring with it perhaps some uncertainty and dislocation. So especially as it relates to advertisers. So we shall see.
And again, Twitter shares rallied today by 27.1 today. Tesla was also higher today, up by 5.6%. Recapping, S&P up 36, a gain there of 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. And I got to say, Tim, we are constantly trying to figure out what life is like post-pandemic. I feel like our conversation with Kathy got into it, certainly addressing the geopolitical concerns, what it maybe means for the energy markets. And our next guest really has been, and we've been kind of talking about the fitness world among trying to figure out what it's like post-pandemic.
Well, one company that has a really good idea of how to navigate through a pandemic is Crunch Fitness franchise. Ben Midgley is CEO and founding partner of Crunch Fitness franchise. He joins us via Zoom from Portsmouth, New Hampshire. Ben, how are you?
Great. How are you? Carol, nice to talk to you again as well.
Yeah, great to have you back.
It's good to have you back with us. Give us an update on what we understand that you saw a 5.6% membership growth during the height of the pandemic. You're now 134% of pre-pandemic membership levels. You're outperforming some of your competitors, Ben. I'm wondering, though, if you see it ebb and flow when we start to see waves of the pandemic come back.
In terms of the influx of memberships?
Or in terms of actual activity, like in terms of people actually going.
We
Perhaps
want
they're
to know,
staying.
are people pumping iron inside?
Well, the truth is you have access to an amazing trove of real-time data, and we're trying to just understand how people's habits change if cases are going higher.
Yeah. Well, once we got out of the real height of the pandemic, I'd say probably, October of 21, then things really started to normalize in terms of check-ins. And then obviously we got the Omicron flare up, and you saw a little bit of a dip in January, but we were well, at least in our case, back to pre-pandemic workout levels. And just last month, we've had record check-ins. We did about 8.5 million workouts last month. So January, February, March, extremely busy, but March probably did 1.5 million to 2 million more workouts than we saw in January, which I think was when Omicron was just sort of coming out of the public eye and people started to relax their restrictions more broadly across the country. So the return to the gym has been pretty solid right now.
So what is it that people want differently, Ben? I mean, are they just kind of going back to the way things were pre-pandemic?
Well, the one, I think, interesting trend we saw in the gyms, and we have a pretty much a full-service club. We have HIIT classes, which is your functional training, about 100 yards of turf, about 100 plus feet of turf in the clubs where we have functional activity. We have the Ride, which is our spinning classes. We have group fitness classes and a large array of fitness equipment. What we did see is the group fitness classes in the enclosed room for a period of time started to have a decrease in usage because I think people were a little bit concerned of being in confined spaces. And then the HIIT classes, which are out in the center of the gym, and most of our clubs have 20, 30-foot ceilings, got incredibly busy. And in fact, our membership mix switched a lot. So we're selling now about 25% of our memberships are the all amenities membership, which includes the HIIT classes, because I think people are enjoying that activity that's a little more intense now, but also in a much more of an open air environment.
Hey, it's so interesting because we saw this rise in at-home fitness during the pandemic, and then we saw the prominent stumbles from Peloton, sort of the epitome of the stay-at-home movement. And I'm wondering, what are the different types of classes that people are doing now that they're feeling more comfortable going out? And are you seeing a real shift in them? You mentioned some of them just now, but are you seeing a shift in them versus pre-pandemic? Like, what are the permanent changes that you see at the gym post-pandemic?
Sure. Well, I mean, talking about the gym and the industry at large, obviously, like you mentioned, when the shutdown occurred, digital workouts went through the roof. We had a digital service called Crunch Live. We've now rebranded that to Crunch Plus. Even though we're a brick and mortar company primarily, our online workouts went up to over 100,000 workouts a day during that time, which was dramatic for us. Obviously, that's decreased substantially at this point. And the same thing happened with Peloton and some of the other, online or digital exercise platforms. They went up dramatically and went down. Now what we've seen is people are pretty much 100% comfortable anywhere in the club at this point. There aren't really any mask restrictions anywhere in the country anymore. But you originally, I should say, I thought there was going to be an entrenchment in sort of hybrid fitness, where folks would be doing digital and brick and mortar workouts. And I've changed my perspective on that over the last 4 to 5 months, where you really have a camp of folks that are going to be back in the gym on a regular basis, a camp of folks that are going to stick with digital, and you have about 30 to 40% that will do both. They'll just do both forever, right? They're comfortable with it, but I thought the percentage of hybrid was going to be a little higher, maybe be more the mainstay, but now that things have normalized, I think we settle back in.
That's where I want to jump in, Ben, because I think some of the conversations we had is that we all thought, just like in retail, it was going to be omni-channel, on the other side of the pandemic. And I think it sounds like what you're finding is, there are some people who do both, but they really want to be back in the gym. And so that's at, those digital, right, coming down.
Oh, yeah, definitely. Look, I think what you find is the folks that are more exercise advocates or really have a need for convenience and, short duration exercise prefer the digital workouts occasionally because it fits their schedule a little bit more effectively than, driving to a gym and working out and making the time to come back. But largely, if you were a gym rat before the pandemic, you're a gym rat again.
Where's the opportunity for innovation within the spaces right now?
Well, I think if you're in our position or any, leading brand, you need to have a digital component, right? Just for that convenience factor. I don't know that you're out trying to compete with Apple or Peloton to make digital a large, part of your revenue, your revenue picture there. But you do need to have it as a really, premier benefit for your members. Otherwise, you're sort of falling behind. In-club programming always needs to stay fresh. You need to have a really clean integration between your website and your mobile app, and reserving classes or doing upgrades or managing your account or just staying in tune with what's happening at the club or healthy recipes. The community effect, right? So that's important. Improvements in technology in the clubs, and recovery is a really, really big area right now. Right after your workout, so you can go and get a hydro massage or do some compression therapy or assisted stretching. That's really become very popular.
Count me in. I'm ready.
So am I. Hey, Ben, just the last minute we have with you. We see COVID restrictions changing around the country. I'm wondering what people's behavior is inside the 400 locations that you have throughout the country. Are masks required in some of them? Are people wearing masks? How would you characterize it?
Yeah, I mean, there's really no requirements across the country anymore that are, placed on health clubs, but you will see folks coming in and wearing masks if that's what they choose to do. And obviously we want everybody to feel as comfortable as possible. So I'd say you see maybe 10% of members wearing them now.
Do you require employees? Still at a lot of restaurants we go to in the New York City area, employees, servers, waitresses, waiters are wearing masks.
Yeah, we don't require it unless the city or the town ordinance requires it. And of course, if an employee feels more comfortable wearing it, we encourage that.
All right, we're going to run. Any nervousness about another variant? Just quickly.
Really, I mean, obviously, just for the health effects it would have on the general public, but in terms of the business, no, because we've been through this now several times, so we're ready for whatever happens next.
All right, well, always good to catch up with you, Ben. Be well, Ben Midgley. He's CEO and founding partner at Crunch Fitness franchise via Zoom from Portsmouth, New Hampshire. So
I got to get to the gym.
There's things coming back to quote unquote normal.
Certainly feels like it.
What a day. Great conversation with Kathy Wood. Go to Bloomberg.com if you missed it and check it out. It's definitely on the Bloomberg terminal. It'll also be at Bloomberg.com. Have a great evening, everybody.